Welcome to the Flywheelpod, where we cover all things Frax Finance. And in today's episode, man, Dave and I had the
Oh
privilege
my
of
goodness.
the privilege to be in the presence of one, Sam K from Frax Finance itself, and also Robert Sam, aka the Godfather of seignorage share stablecoins, algo stablecoins. Dave, how was the episode?
I'm speechless. Like, I'm still trying to process everything. I'm like super humbled and grateful that that Robert decided to come on, and like we feel really lucky to get like literally like the Godfather, the intellectual Godfather of algo stables and automated stablecoins, with quite arguably the best in real world implementation of that idea, and just hearing them go like back and forth, asking each other questions. It was all super organic. You can tell, like, I think my favorite thing about the episode, like, at the beginning, like we set the stage, we set the foundation, and I have to like prepare the viewers. This is very deep. This is like very, very like rich in content. But they set the foundation there, and like once they set that foundation, like they've literally built like the most beautiful sculpture. Honestly,
Agreed.
like, and
Agreed.
they each got, you can hear it in their voice. They each got more and more and more excited, and it was just like it was really, really special to watch. I'm just so happy. Like, this is like one for the history books, and we were like,
Dude,
we helped bring it together,
yes.
and like we're a part of it.
Dude, and I love how they always went back to first principles, right? Nothing is
Yeah,
assumed, and they literally iterated from that foundation, which made it like such a rich and robust conversation on both ends, and it was great.
yeah. Like
Is that
this is
enough?
one for the books.
Yeah, exactly, exactly. This is going to be, definitely one for the books, and I cannot wait for you guys to actually listen in on this. And once again, you can follow us on at Flywheelpod on Telegram and Twitter. And if you go to YouTube, you can find us at Flywheelpod. Make sure you smash that subscribe button and please share this episode.
Hey everyone, welcome to Flywheel. Today we have a very special episode. I've like when I heard about this episode today, like that we were doing, I was like, wow, this is like pretty monumental. We literally have the godfather of algorithmic stablecoins, Robert Sam, and then we have one of the most successful implementations in the real world of that paper, Sam Kazemian, the founder of Frackstone. So this is going to be a really special episode, and we'll just get into it. How's everyone doing today?
Great.
Yep.
Awesome.
Cool.
I'm super excited for this one. This is going to be one for the books.
Yeah. Let's get into it. So, Robert, I'm going to start with you. Your paper, when you first wrote it in 2014, it was a lifetime ago in crypto time. Literally, it was just all like Bitcoin was it. It was all proof of work. There was no proof of stake. Curve didn't exist. DeFi wasn't even a word. And like, did you think that your idea would lead to like such experimentation with different stable coins, and also lead to so much creation of and destruction of value so quickly in each experiment?
Yeah, no. So I didn't, or at least I didn't think it would kind of go the way that it did in terms of the variety of different protocols, and the context is really important because like you said, like in 2014, kind of put your mind back to what things were like back then. We were still like debating the nothing at stake problem, and the underlying assumption that was being made, not that like I thought proof of work was the end state at all, but like that was an assumption that was widely held. So it was like future state where there's half a dozen proof of work blockchains, and there's no DeFi, primary use case payments, like that was like the underlying set of background assumptions when I wrote the paper. And like I did kind of like, and the paper itself wasn't like meant to be protocol specification or something. It was more of like a thought experiment of how to solve a couple of problems, which I thought shed some insight into like how the very small community at the time that was thinking about this stuff, and some of the problems that we were working on at the time. So I think I did think the idea of a decentralized like crypto asset stabilization was something that was going to take off. But I thought a lot more research would take place before stuff went into production. So I certainly didn't anticipate the proliferation of the different projects and all the different things that were tried, and some have been successful and others haven't.
Yeah, Sam, then actually, I have a question for you to follow up on that. So when you first read Robert Sam's paper, or when you read it a few times, Robert said it was a thought experiment more than an actual like protocol specification. So like, how did you take his idea from paper and make it into an actual protocol?
Yeah, so I kind of want to set the stage here because I think whenever people ask me to speak, or I'm on like either a panel or something, I actually kind of refer to the Signer Shares paper as kind of the Bitcoin white paper of stablecoins, and I really like it. I've read it a bunch of times. I think it's had a lot of both impact as well as just overall it's really well written, and like Robert said, this was in 2014. I got into crypto right around there, actually 2013, 2014. I was mining proof of work coins at my college dorm in like UCLA back then. There was like Dogecoin had just came out. It was like the script proof of work mining boom and stuff. Ethereum wasn't even really an idea even yet. Like it was about to be proposed, and like there was stuff like counterparty and colored coins, which I'm sure Robert remembers, and it's probably a lot of OGs remember, but it's past a lot of the newer people that have come in like the ICO cycle. But I want to kind of set the stage because I kind of bill myself as like a stablecoin historian as well. If you're going to build something that's really moves the space forward, you have to understand what came before you, both in terms of thought and also in terms of execution. And the thing here is that I find really important about the original, Sino Shares paper is like it basically was the first time, really, in a well written paper talked about stabilizing the purchasing power of a crypto asset on chain. And if you guys have read it, extensively, like I have, obviously Robert is the one that knows the most about it out of anyone in the world. A lot of it talks about actually like proof of work oracles, and like if you can even stabilize something based on the hash rate or the electrical cost. It actually is a very thorough paper, and it goes through and starts out as saying something like, if you have a blockchain where one of the assets have to be stable and also non-custodial and decentralized, right? Like a Bitcoin like asset, how would you go about and do it? And it's very methodical, right? It first talks about, okay, what if you just have these two wallets and you deposit this stable coin, or it's just called coin, and then it's a savings wallet, and then you can move between them, and the savers get the price stability, and then you can move it to this other wallet that you get exposure to the price, the supply changes, right? And then he clearly exemplifies what's wrong with that. If you can move at parity at lightning speed between these two wallets, you're basically not doing anything. It's almost similar to Ampleforth, right? Which is like you don't actually create monetary policy, right? Which is like the Hayek money example. And then he finally proposes the kind of finalized design to explore, which is you need two tokens. You need a coin, which is a stable coin, and you need another token that he calls shares. And then he like highlights, well, if you hold the shares, you expect it to be volatile because it's kind of this thing that you get the future seignorage in some mechanism. And then if you hold the coin, which is supposed to be stable, you get the stability of the system, and you shouldn't expect as much price movement. And it's a very well-written paper. And for people that haven't read it, that will listen to this, I highly recommend you read a piece of crypto history. Now, the thing is, I've studied pretty much every single stablecoin that you can probably think of that has any kind of significance, from like the new bits, the Dan, oh, there, yeah, the Dan Larimer stuff originally with like BitShares, BitUSD, the new bit stuff that came out there, Basis, right? The 3 token system that they proposed and didn't launch originally, like the shares and the bonds kind of thing, right? And then, then it was implemented as like an anon, project. And I've studied all of these things. And I think there's a lot to be said about the evolution of thought in the space when it comes to stabilizing crypto assets, and the stablecoin industry as a whole. I always say is like the third $1 trillion narrative in crypto, because it really is the last kind of $1 trillion addressable market. The first two being Bitcoin as like the first digital scarce asset. The second being kind of what Ethereum represents as like the world shared state, ledger for executing, arbitrary code and things like that, settling shared state. And then stable coins, which are basically non-custodial or quasi non-custodial, depending on the design and the fiat reserves and stuff. And this is what always made me really passionate about crypto. I really wanted to build something in the space that had as much of Bitcoin's ethos of bearer asset, non-custodial, while having on-chain price stability, on-chain, market operations and things like that. And that kind of led me to, designing Frax and iterating it out with the core team and everything. But just to set the stage, I wanted to explain this here because it's really important to highlight the kind of evolution of the space. So yeah.
Cool. Wow.
That's a great way of setting the stage, Sam. It's really good.
The stage has been set. The foundation has been laid.
Yeah.
Sam, I remember like when we were living together, you like reading the white paper that Robert wrote and watching all the Robert Schiller videos and everything just to get like a foundation, like even back then. And like it's just like really full circle and cool to see like where we all now. Kiet, how you doing? How you feeling about all this?
I feel like I'm just soaking in all this stablecoin royalty right now. I'm just feeling this regal power coming from the both of them, and I love to hear from like Robert here. Like back then you wrote this on paper, and then now you see all of these experimentation on chain. Does it make you feel a little happy, or like are you satisfied to see like what you wrote actually materialize and somebody's actually experimenting on chain, or would you rather prefer more research and more kind of like paper rather than protocol?
Yeah, I'm certainly happy to see the experimentation. I don't take any credit for it because like there's a lot of like mostly independent thinking in all of these projects. And I think and there are a lot of novel, or not a lot, but like few key kind of novel ideas I had never thought of that came out of these experiments. So I've learned a lot by watching them, and I take like one of the frustrating things about like doing something like thinking about the stuff and writing for the first stab attempt at like defining a problem clearly in something that you couldn't really test then is quite frustrating. And I'm a pretty empirically minded person, so to be able to to look at the the real world experience with this stuff so far has been amazing. I've learned a ton from it and continue to do so. So I think certainly happy to see how it's evolved. Unhappy with a lot of the things that evolved too, but uh,
Yeah. So you mentioned that that with all the experimentation, there are things that you haven't thought of and you didn't write about that actually played out in real life. So what are some of those things that you saw from different stablecoins, whether it was Frax or other ones?
Yeah, so I think with the this CDP based model, that started with DAI, which I was really skeptical of initially, and I still kind of skeptical of it for I think there's some kind of risk scenarios with it that haven't been explored enough. But I think the getting to understand how the CDP based model can work, I think has been really interesting. Been very interested to see the sort of second generation of CDP based systems, particularly Rye, and the the use of PI control in stablecoin designs, which is something that I didn't really describe it this way, but it's sort of implicit in the way I saw the seignorage shares mechanism working, based on PI control thinking in terms of the auctioning of supply, and that's been super interesting. And with Frax, to kind of generalize the idea to something of a, it's not really a synthesis of the CDP model and seignorage model. It's different, but to see how something that on the surface of it looks quite complex, but when you dig into how Frax has been designed, it's a quite elegant model, and it solves a pretty key problem in decentralized stablecoins, which is the how do you keep a collateral, how can the collateral backing grow with the demand for the coin, and there are a number of other things too that are a bit more techy and nuanced, but those are some of the key things.
Yeah, I wanted to following up on that, Sam. So when you started Frax, it was actually looked very different than the Frax that is today and Frax that you plan to build in the future. So I'm wondering how what was the process of deciding what to change in the Frax protocol, and how, and what inspirations did you take, and how did you make those changes?
Yeah, and I think this is actually really important for people probably listening, because there's kind of this philosophical battle between the views for algo stablecoins and like Robert was saying, CDP based debt ones. So the main thing for everyone that isn't familiar with Frax is that when we were designing Frax, we thought, look, the seignorage shares model is really smart and clever, except it looks like a bank without a balance sheet, right? It looks like basically a central bank or just a bank, whatever, without any exogenous assets. And in traditional finance, you don't do something like that, right? You don't issue liabilities, or basically short-term liabilities on demand deposits without any exogenous assets, and say, hey, with equity, essentially, for the future growth or speculative outcome of the system, we will try to make all the liabilities whole on redemption or something like that, right? And this is also, I think, still currently one of the main orthodox arguments against algorithmic stablecoins. And when we designed Frax firstly in 2019, what I thought as kind of the key point here is like, if the seignorage shares model or any of it has some merit, which I obviously think it does, it needs to basically be a mixture of a dynamic system where the stablecoin has a balance sheet, and the balance sheet of exogenous assets is dynamically changing between a hybrid model of being stabilized by the exchange rate, right? The shares component, and just being fully backed with assets, whether they're debt, whether they're other stable coins, whether they're Ethereum or volatile ones or whatever. There needs to be some collateral ratio target as well, so that the ratio of liabilities to hard assets is something that can be adjusted to bring market confidence to the system. So, like, for example, you can see the Frax historical collateral ratio. Right now, it's actually quite high. It's almost 90%. It's like 89.75. It's went as low as 82, which is still pretty high and fairly, collateralized. It's actually similar to DAI than it was ever to Terra and UST. But the idea here is you can have some algorithmic component, aka a component where it does not have hard assets, but that the exchange rate is basically stabilized by changing the supply, right? Having some part of the supply of the stablecoin change by the seignorage or the governance token of the system. Now, I think this is still the main crux of it, and I'm really interested to hear what Robert has to say, because I think in 2014, when he wrote this, and stable coins were not even a term, basically, right, and like Tether had basically barely even come out. I think people in crypto were not thinking in orthodox financial terms, right? Back then, like he was saying, everything was proof of work coins. We didn't even know, back then people said Bitcoin was going to be a payment system. Now the narrative has entirely changed to digital scarcity, digital gold. And like, back then I remember people like, you're going to be able to pay with your coffee with Bitcoin, literally to the coffee barista's like literal Bitcoin address. No one even bothers saying any of this stuff, right? It's either, it's going to have to be through apps or Lightning or whatever, or some scalability solution. But now that
Although I
we've
have bought a
progressed as
coffee
an
with
entire
Bitcoin.
industry, yeah, and like,
Right.
now that we've progressed through the industry, and like the stablecoin, industry is very sophisticated. There's both traditional orthodox views as well as different kinds of schools of thought. I'm curious to know what Robert thinks about the kind of traditional financial criticism of the signer shares model, which is just like, this looks like a bank without a balance sheet, right? And so how would something like this ever work, right? That's the main criticism of the design.
Yeah, I mean, I think, and this is a good criticism. I think, I mean, I like. So one of the parts of like the idea behind seigniorage shares, which actually gave the name of it, was that like there was like an argument for why the volatile coin would have value, based on like net present value of like demand growth, basically for the demand growth in the stable coin. And like okay, that could be the case, under certain conditions. It was like less unreasonable of an assumption given the sort of background context in which the time the thing was written. If you're talking about like Bitcoin being like a a payments rail, like a payments coin, which people were at that time. Like the idea of a two token scheme, also being that and being better than that, and and capturing like serious network effects, because there wouldn't be much competition in a world where you only had proof of work chains. Then yeah, it could work. It could even work more likely to work if the thing that you're like the stabilization index is like designed to lose value over time. So like it's like inflationary, like it doesn't hold purchasing power, much like a fiat currency does. But like you can do a lot better than that, right? And so I was actually quite skeptical of the idea of like the seignorage piece being a good form of collateral. Like shortly after I wrote the paper, and I kind of talked about it in some public talks after. But I think but so that's kind of one part of it. But there are multiple ways, though, like the other dimension of the way the mechanism worked is this kind of two token model where the supply of one expands versus burning the other, and vice versa. And the volatile coin doesn't necessarily have to be derive its value from seignorage. The volatile coin could derive its value from something else, like transaction fees. So it'd be like a velocity coin, right? The seignorage coin, and and that idea was a lot more plausible, and much more plausible, in a proof of work, assuming it's kind of a layer one coin, like in a proof of work system, or a layer two coin where the coin can capture some transaction fee value. That seems like that seemed to me like more plausible. But the idea that like seignorage on its own is adequate, I don't think is sufficient source of value for for the collateral. So I think there's a lot of like in that what Sam asked in terms of like that kind of traditional world criticism. I think when you break it into its components, there are actually different aspects to the criticism. Like I think there's one, is seignorage like a good argument for why that coin's going to retain the value which it needs to in order to absorb coin contractions. So that's kind of one criticism. I think, yeah, under certain conditions, yes, but under certain other conditions, like the way the space has evolved, no. But there's also something that I hear a lot of, which is there's something wrong with the fact that the collateral backing the coin is like endogenous to the stablecoin protocol, as if having some coin that's not part of the stablecoin protocol magically gives it more value. And that criticism, I don't really see the merits of. Yes, like a collateral that's endogenous to the stablecoin protocol is got characteristics that exogenous collateral doesn't have, and vice versa. But the trade-offs, one's not better than the other. It depends on what the system's designed to do and the assumptions you're willing to make. So that criticism that I've heard a lot of, I don't really think holds. But overall, when we kind of step back from those two aspects and just look at the financial view of the space, a skeptical view of the space, and I think there is, I think a lot of it is driven by an underappreciation, even within my old industry, of how money and credit really works, right? And there is ultimately fiat currency and the central bank and the banking system that give rise to it. It's a network effect, and and there was so if you can kind of tell the story this way about fiat currency and central bank, and people say, well, the dollar, that's backed, right? Well, central bank dollars, yes, that's backed by government bonds, which is really safe asset class. And if you ask the question well, why is that a really safe asset class? Well, it's a really safe asset class because the government won't default on it, because if it's more rational for the government to print money to pay back the debt than default on it. So there's nothing like circularity to what gives the sort of most risk-free form of money in the economy that character. Of course, the private sector can't emulate that in the same way that the public sector is, but it shouldn't allow us to adopt these mental models like there's this kind of like form of money that's like real, kind of like gold. And then there are these kind of, like wacky credit, things. Because the whole system is a kind of a wacky credit thing. It's amazing it works. And that's just central bank money. Commercial bank money, which is most of the money supply, is backed by what? The whatever crap the commercial banks have on their balance sheets, backed by loans and mortgages and other things like that. So like so when so I think that even within the financial industry, there's a lot of complacency with respect to the underlying source of value in the monetary order that we currently have. But that's a bit of a tirade. I think probably the more informative answer to your question are those two aspects of the criticism that that I've heard a lot of. But I'm curious to know
Yeah,
what Sam thinks.
that's really right on and well said on basically all counts. And I think I agree with pretty much everything you're saying. What I would say though is it's interesting that, you know, the way to think about uh, crypto and value is there's this battle between classical and orthodox financial way to think about it, right? Is running a stablecoin protocol like running a bank, but just, automated and using smart contracts and digital assets on chain, or is there some new, phenomenological like thing of value here that like you're doing by creating this new paradigm? I think that so far there's something to be said about the way that traditional financial, laws and like macroeconomic laws, not literally government laws, just economical laws have like played out. I almost see economical laws as kind of like laws of physics that like they'll play out the way in like a free market, right? And the thing here is, it appears that a lot of stable coins that actually work so far are modeled like banks, right? And so far. And the interesting thing, though, is some blockchain things are not like banks or businesses. Like Robert says, for example, if you look at Bitcoin and you just look at the Bitcoin network as a whole, right? And you try to analyze the Bitcoin network as a business, right? What is the equity component? Like, is it, I guess the closest thing would be like the Bitcoins themselves, but they don't ever have a right to transaction fees, right? Like Bitcoin is proof of work, right? They don't get you anything. In fact, Bitcoin is the network is diluting itself, of coins, right? And the quote quote shareholders, or the closest thing to them, the Bitcoin holders, they don't ever get the revenue from transaction fees, right? And so if you do this orthodox analysis of a lot of stuff in the crypto space, things that people would not say are, scams or Ponzi's or unsustainable things, they also just look bad, right? Bitcoin, if you look at it from the orthodox view of business, it's probably the worst business conceived in the history of mankind, right? It's emitting like billions of dollars of value per year, right? And it will continue to do so. It will not capture any revenue for its quote quote shareholders, if you could even call it that. And if you even say there are no shareholders, then even worse, right? Then what is the value that the Bitcoin network is capturing? It's almost like you cannot actually model this like a corporation, a firm, or a bank, or any kind of traditional financial activity. So therefore, you either have to say Bitcoin's going to zero because there's no other way that it can capture value, which seems crazy because I don't think Bitcoin's going to zero, right? And I think, like I said, it's a $1 trillion market of the industry. Or you have to admit there are new, phenomenological ways to create things of value through, network machines that are automating a certain kind of processes. So I would agree with a lot of what Robert's saying.
Yeah, it's an interesting way to put it, Sam. I mean, I think one thing I do wonder though is is it actually new? I can like the idea that like Bitcoin has value in the same way that gold has value. I'm not making this argument, but a lot of people make it. Isn't it isn't a stupid argument, and it's not one that's necessarily new either. It's like the idea of, well, if bitcoins have the like certain characteristics that make them a useful store of value and a useful medium of exchange, like gold throughout its history, has had for for international trade, and the kind of basis of the gold standard. It's got this metal, and it's got these characteristics people use, and then it derives its value because it's monetized. That the people use it as a store of value in a media exchange. That has like an additional value above and beyond any intrinsic utility that it would have for industry, jewelry and so on. And it's like you could say, well, Bitcoin's kind of like that. It just doesn't have the residual value for like jewelry and stuff. So like it's purely monetized value. And then the question just really hinges upon, does it have the characteristics to of something that has monetary value? Then that's open to debate. But
Yeah, and what's really interesting that I also want to highlight that you're saying is looking at things in this historical lens and also trying to document crypto history, you can see the different path that Bitcoin and Ethereum are taking, in the sense that it's pretty clear how you can build a case for Ethereum as a network, as an orthodox traditional financial business, right? The product is block space and execution, right? EIP 1559 is essentially an automated share buyback and burn, right? The revenue comes partially in the form of fees. Some of it goes to validators, whether it's currently proof of work miners or later it'll be proof of stake, whatever. But then some of it is captured by the ETH token holders through these burns that are essentially distributing value back. And then the product, or the thing of value, is the block space and the shared state of code execution. So that has a very orthodox view, and everyone understands that. Whereas Bitcoin, depending on where your philosophical leanings lie, either has no answer to that, and like you're bearish on it, or you're very philosophically bullish on what it is as a commodity.
Yeah, no, I agree. And especially, in the Ethereum case, is you can definitely apply very orthodox business valuation principles to it. You can even quote like ether value as like a multiple of gas fees. As determine whether it's rich or cheap on a fundamental basis, which you can't do with Bitcoin. But then at the same time, I don't think you can do that with gold. Like gold doesn't generate any income. So in order to give a economic analysis of gold, or a lot of other commodities, but gold's the interesting one because it's sort of got some monetary value to it. You've got to kind of think more like a Bitcoiner, and I don't think those I don't think that's there's sort of traditional versus new. I think it's all just finance and economics. It's just applying the right model and framework for the problem. I've never seen anything in crypto which is obviously new and amazing, exciting space, and but the underlying kind of economic principles and financial principles apply. They're not they don't change because of technology. So in a sense, and this might sound really boring, but I actually don't think there's anything that new in the economics of the blockchain space, stable coins or otherwise. It's the new stuff is actually figuring out how to apply the universal stuff that always holds to the particular case, which isn't always obvious. Like they're kind of problems that are quite hard to get your head around. But like once you get your head around it, it's like it sort of demystifies it, and you're like, oh, this is kind of like valuing an equity, or this is kind of like a bond, or this is kind of like forward rate agreement. Like they're all kind of the same analysis applied to just a new context. At least that's how I see it, and I haven't seen anything yet that leads me to think there's like some kind of new underlying economics to the space.
Yeah, I mean, what you guys are basically saying is, I mean, one thing that really stuck out to me, what both of you are saying is like, especially about Bitcoin, is like, even though like the mechanics and business sense of it don't really make sense, like why does it have value the way it does? What it really comes down to is faith, honestly, and belief that it does have value, whether it's Bitcoin or stablecoin or something else. And so that leads me to my next question for either of you. What do you think the keys are to, installing that faith like early on, and like how does like whether it be a stable, well, I guess we'll talk about specifically stablecoins, like how do stablecoins like get adoption from the start, because it's like really hard to begin with, but like once it starts getting that network effect, it's more like just a snowball that just goes. So any of you guys can jump in.
That one should be for Sam.
Yeah, Sam, you can jump in.
Yeah, so this is actually an interesting thing because what we've done with Frax with this dynamic collateral ratio of like, partly, algorithmic supply, partly backed by hard assets and other stable coins and loans and things like CDPs and stuff, is that we've realized actually you can quantify what you're saying in terms of faith and belief, because all of Frax is on chain, right? And all of the assets held are on chain and smart contracts, and the whole thing is meant to be non-custodial, right? And for example, when you say faith or belief, one way that we look at Frax is total state, right? The entire state of the circulating supply, the addresses that own it, where it is, and stuff. You can, for example, see exactly how much debt is denominated in Frax on like Aave or Compound. For example, you could see there's 100 million Frax deposited there. Half of it's borrowed, so there's $50 million of debt denominated in it. But then actually that borrow literally got deposited right back into Aave, and then someone else borrowed that 50 million. So now there's actually 100 million of debt denominated in it, and it's like a 2x turnover. That debt has to be repaid eventually, right? So that represents 100 million Frax of demand, right, at some market value of the collateral. And you can, for example, see other places where Frax is integrated in locked liquidity. Like we also have locked liquidity gauges and farms. Other protocols do as well. So there's literally Frax that is being market made locked in smart contracts, right? Like that Frax cannot actually be pulled out at will by anyone. And you can see how long it's locked up, right? And so these are basically just mathematical ways to say, these are integrations, right? These are integrations that you can rely on in the total current state of Frax's economy, because it's all on chain. And then you can do an analysis and say, okay, given that there's, $100 million of Frax debt, and that has to be repaid, and it's backed by loan collateral, given that there's, $200 million of Frax in locked liquidity for at least 12 months, all of that implies, for example, that you can have 11% of the current Frax supply be algorithmic, because it's integrated, and it's there's no possible way that there could be a bank run or insolvency, in classical terms, where enough Frax has to be redeemed from the protocol's collateral and liability reserves, right? That basically allows the protocol to expand slightly the money supply, right? Given the actual on-chain outlook. And this wasn't possible with like Terra, because they did a lot of stuff with market makers and off-chain centralized exchanges and stuff. It actually looked more like the Federal Reserve, which doesn't have like a complete programmatic view of every transaction in the economy, right? Like what they do is they raise the rates and then they say, oh, okay, what happened to inflation? Did the CPI report, did inflation go down this month? Oh crap, it didn't. So let's raise the rates again. This looks bad or something, right? But if the Fed actually had the way that we look at Frax, they can say, okay, all dollars are here and here and here, and they're going to be spent on oil or this and that, and we have to raise rates now, and then we can bring them back later and stuff like that. So we can do that with Frax, and that's part of the reason why we've always held the perfect peg. One thing we're really proud of is that Frax has never actually broken its peg in its 17 months of existence. And so the important thing is, like, you can quantify now the actual belief or the faith or the integration of the currency in the economy, which I think is a really important thing to consider if you're designing a stablecoin.
Yeah. No, I think it's one of the most exciting things about like the space is that like the ability to quantify this stuff empirically in real time, gives you insight into how the system works that you just do not have in the current economic system, and it also opens up opportunities to target certain types of demand, certain patterns of use cases that drive the demand that you want, and create incentives to discourage the types of demand you don't want, right? And I think that's like a really appreciated part of the problem is the demand side of the equation, because a lot of attention is placed on like the mechanism for changing the supply, the way the collateral works, but what the demand is in your system is really key. And to your question of like how do you get like adoption behind that, like I don't know, it depends on the case, but I think to answer a slightly different question, I think it's not just adoption you want. We see there was a lot of adoption in Terra's anchor protocol. That wasn't particularly great. You want demand in a stablecoin that's got a certain character to it. Like it's quite sticky. There are use cases that are creating value for the transacting parties, so they're going to continue to trade, as opposed to like it's creating value for somebody today, but it's going to come from the wallets of somebody tomorrow because it's Ponzi like. You don't want that kind of demand. That's not going to make a sustainable system. So finding like the use cases that have the characteristics that make it possible for the stablecoin to accommodate the volatility in that demand, and those use cases being like sticky in nature, because that's really where the network effect comes from. It doesn't come from the stablecoin itself. It comes from ecosystem of composable use cases that are like high quality in the sense that they create value for its users, and they're quite sticky because they're composable. And
Robert, yeah, actually, like you just made me think of another question that just popped in my head. If you had a critique of Frax, what would it be? What would it be? Have you like thought about that at all, or is it like, oh, this is like how a stablecoin should be implemented?
No, I don't have any fundamental critique of Frax, and like any critiques I have of like the seignorage piece of it. I think Frax is like far less exposed to that, those problems than other projects. So no. I mean, there's some things I'd like to understand better in Frax.
What would they be?
I'll follow offline to Sam about them.
Yeah.
They're related.
I also think
They're related to the redemption mechanics and some things around that. But I don't.
Yeah, and I also think like the most common, I think from a philosophical perspective, I mean, just like the peg obviously speaks for itself, and now there's a lot of Lindy effect around the fact that everyone's seen like, okay, this thing has been battle tested in pretty much as difficult of times that people have seen in recent memory, and like for years in crypto. Like this past month has been probably up there in one of the harshest climates, both macro and crypto. But I think one of the more common critiques, which isn't unique to Frax, but is indeed a criticism of even DAI and other stablecoins, is that are all stablecoins just baskets of other stablecoins predominantly, right? Like Frax does have a lot of protocol owned liquidity against USDC and DAI as well, right? And DAI is famously like 70%, 60 something fiat coin, and USDC. It gets this joke of they're all just wrapped USDC, and then underneath USDC is all treasuries, which are very safe, but like so that they're just wrapped dollars as well, and is the only real way to get very high parity performance against the dollar peg. Just is it turtles all the way down, right? Is it just stablecoin T-bills all the way down? And I think that's the general critique of the on-chain stablecoins. Right now, Frax and DAI are the two largest on-chain stablecoins. They're the only decentralized non-fiat coins with over $1 billion of supply, and they both have somewhat substantive, and true exposure to fiat coins, right? Frax has a lot of its protocol and liquidity on Curve. It is immune to the blacklist things that people say to against USDC, because USDC would have to blacklist Curve as a protocol and like Uniswap and basically implode those protocols to hit Frax's USDC and those system contracts. But the critique is on point in the sense that if Maker didn't have USDC, if Frax had no exposure to USDC, and it was just Ethereum or Bitcoin or something, could it have had this perfect peg performance? And I don't know. That I think is a question that critics are still posing.
Yeah, I mean, I kind of agree with that. I mean, and it's not unique to Frax, as you said. But I think we might be able to rephrase the critique in a slightly different way too, or a more general way, which is like it's not just the turtles all the way down to USDC story. It's also the tight coupling of the collateral pool with the protocol itself, which inevitably involves a governance dimension to the protocol, and it would be really nice if you could decouple those things. It'd be really nice if you could have the collateral that's backing the stablecoin be be something like Ether only, or an endogenous collateral, and have the system grow in supply outside of the protocol, like you see in lending protocols like Compound and Aave, where you can get a money multiplier effect, which is kind of like stablecoin is kind of like a lending protocol in a sense, where different types of collateral can be used to not mint new coin, but to borrow new coin from lenders, and it to be truly decentralized, because it's external to the stablecoin protocol. So you don't have this kind of scenario where for the stablecoin to grow, we need to grow the collateral pool, and that's a centralized, a logically centralized decision with the stablecoin protocol. And I've never liked that. I've never liked the idea that we've got to use governance to make the decision of which collaterals are okay and which ones are not. But that's that's not really a criticism. It's just more of an appreciation of the trade-offs involved, and a vision that it would be nice not to choose that trade-off space.
So that leads me to another question to Sam. So you have Fraxlend coming out pretty soon. With Robert saying about lending protocols, how do you take that into account with Fraxlend, and how Fraxlend can be utilized to basically help proliferate Frax?
Yeah, so with Fraxstone, it's an isolated lending market with very customizable, we call them on-chain term sheets, which is you can modulate the interest rate model and the collateral type, as Robert says, and then once you deploy it, it's automated and it goes right. So imagine if you had your own instances of the compound protocol, but like one asset and terms against like Frax borrowing, right? Like, and you're able to basically create Frax debt, right? And so this is really important because it's basically like a CDP engine, right? It's like you can either have governance set these parameters once, deploy this, and then lend Frax on the other side that people can borrow, or anyone can become a Frax lender if they go get Frax and deposit it into the lending side of each specific Frax lend pair, right? And so this is going to be a really unique way to do debt denomination increase, the Frax supply, like Robert was saying, the money effect, so to speak, right? Anyone can become a lender. The protocol itself can become a lender. You set the term sheet, so to speak, of a Frax lend pair on chain, and then you let it go, right? And so it does the automated liquidations with the on chain Oracle and things like that. You can deploy new ones. Anyone can deploy new ones. It's just that getting the lenders from either the protocol or other Frax holders is a free market decision, right?
Yeah.
And so that's going to be really cool.
Yeah, that's definitely the future. Got excited.
You heard that here first.
Like, and with like everything happened like with this last 2 weeks or so, from 3AC to Celsius and now Voyager, like all this kind of CDFI, completely opaque transactions is going to be completely abstracted away with FraxLend, where everything is transparent on chain. You know who the counterparty risks are. You can completely assess the health of this counterparty because you literally see everything that they're holding. And that's why I feel so bullish on this on-chain transparency. Is in traditional finance, you have a prime broker to kind of take care of all of this for you, right? To really give you this specific party's health. But we don't have that in crypto, and maybe that's a good thing. And so it's really relying on products like FraxLend to drive that next level of transparency and health for the whole ecosystem. But now, Frax's AMO relies on all of the other DeFi products, right? From Aave to Compound to especially Curve. And do you think that is healthy for a stablecoin protocol like Frax to rely on other protocols, or should they build everything in-house?
Yeah, that's a good question. So we have these things called AMOs, which are called algorithmic market operation modules, which they're essentially smart contracts with pre-programmatic market operations that either expand the supply of Frax or contract the supply of Frax from a specific protocol, and they burn it based on the price, right, and the market conditions that it's trying to stabilize. So there's really obvious ones, which is like if you have a lending AMO into Aave, you mint fresh unbacked Frax into Aave for the protocol, and people can borrow that Frax. Obviously, they put up collateral inside of Aave in terms of backing it before they can take it out into the market. There's also other AMO contracts like the Curve one and Uniswap, where the protocol basically expands Frax supply into a Curve pool. If a lot of people buy Curve they buy Frax on Curve, and Frax price on Curve is higher than $1, well, that's super easy to fix, right? You just mint more Frax into the Curve pool against the other stablecoin and bring the price back to the peg, and then you earn yield on the LP tokens you got because you just deposit a bunch of Frax into Curve, right? And then the opposite is true. If a bunch of people are selling Frax into the Curve pool for stable coins, then the AMO takes the LP tokens it had during times of expansion, right? It redeems Frax from the Curve pool as much as it can to rebalance it back to peg as much as possible. And so these kind of strategies, they're essentially just market operations, right? Coded in smart contracts, and they basically run, right? You can periodically either poke them or they run by themselves, and then they do the accounting on chain. So like if you actually, you could read the smart contract, what's the current value it controls, or like how much collateral value it has, or it can contract, and it does all the accounting on chain transparently, and everything is reported in the AMO contracts. I think they're a really big innovation. So we actually came up with this in 2021 to build out part of like Frax's algorithmic supply, right? And like the only way Frax's algorithmic supply can increase shouldn't necessarily just be from the seignorage share component. It could be in these programmatic smart contracts, right? And I think that's one of the innovations we pushed out first, and it's actually cool to see that Maker also has basically been doing some of these similar ones. Like they have the DAI direct deposit module. If some of you guys are familiar with that, it basically does the exact same thing as a lending AMO. I think they deployed it about 6-7 months after ours went live, and it just mints DAI into Aave, targets some either ceiling or interest rate, and then it contracts the supply of DAI to hit the interest rate, or withdraws it if they change the ceiling of it through governance. So it's literally the same thing. And I think Maker doing this shows that we were right on with some of these AMO designs and market operation strategies. I think more stablecoins will realize some of these coded market operations are pretty crucial, especially in blue chip DeFi protocols like Aave, like Compound, and stuff.
Got it. Do you think Frax would actually build its own kind of curve AMO would no longer be a thing? It would just be like Frax swap AMO that would protect all this liquidity? Or do you think Frax still needs to kind of be integrated with the ecosystem at large?
Yeah, I mean, we've always been really positive some players in terms of like making sure that we're really building with the most important DeFi protocols. So I don't think we're ever going to like pull anything out in terms of the AMOs that have been deployed already. But you're getting at a really good vision that I sometimes pitch, is like what I call the Trinity stack of DeFi, which is everything in DeFi that I've seen when you abstract it away is lending, liquidity, and currency, right? Or stable coins, right? Everything's just a variation of that stuff, right? You either need an AMM if you want the liquidity to be on chain and decentralized, and then you need a lending facility if you want the lending leverage, stuff to be on chain and decentralized, and you need a decentralized stablecoin, right? And so I call this the Trinity stack, which is every layer of financialization on chain requires those three things, and very few, if any, projects actually have that total trinity. If you think about it, MakerDAO is kind of two of those, right? They have the lending, right? They have their CDP system, and they have their own stablecoin, which they build the network effect around. And you have this money multiplier idea that they're the issuer of DAI and the sole entity that can mint DAI. You have Compound, which has an Aave that have huge lending facilities. They don't have their own stablecoin. There's no Aave USD or Compound USD. And then none of them have an AMM, right, for their own infrastructure, for their own protocol controlled liquidity or things like that. And we recently launched FraxSwap, right? So this is our AMM component. And like you are noticing, we're launching FraxLend soon. And each of these pieces of like this Trinity has unique features. We're not just launching, a Curve or Uniswap fork. FraxSwap has some really unique TWAM tech, and we're working on some really awesome concentrated range designs and things like that no one's ever seen for FraxSwap v2. And I think that a stablecoin issuer, essentially a central bank like entity that can actually have every piece of this stack, can possibly be the one that addresses that $1 trillion kind of addressable market of stablecoins that I was talking about. So that's kind of the grand vision, and we'll incrementally execute toward that. And everything we do, we're thinking about how to kind of move the chess pieces, so to speak, on the board properly, and methodically launch kind of feature and product after product that gets everything in place. So if we can execute that, I think it'll be very, very huge.
Yeah, speaking about like just the timeline and history of Frax, when I explain it to people and how it's evolved, I like to say like V1 of Frax was just a simple like mint and redeem ARB against Uniswap or Compound. V2 was Frax using the protocols themselves to help maintain its peg, whether it's the curve AMO, lending AMO, and then V3 is Frax building its own financial primitives to keep its peg, whether it be FraxSwap and FraxLend. And then, like as it evolves in the future, you're going to see, I assume, more advanced, sophisticated financial products built on top of that. But I want to actually bring it back to the Curve AMO, because right now you have Frax Space Pool up for vote. And you're speaking of chess. And I had this epiphany the other day when I was speaking to my friend. I feel like everybody was thinking about like winning the curve war or convex war was about like who can get like the most tokens or who can like, get the most emissions. But it really wasn't about that. I think like what the curve war was about is like who can integrate with curve on a protocol level. And like that's how you actually like quote unquote win the curve pool. And if all goes well, and I think it will, if Frax, the Frax Space Pool passes, then that's it. Then like that's the game. Like then you won. Like basically, like you took like a very important step in winning. Then you have to like get other stable coins to adopt, which I think I'm more than confident you guys can. So like speaking of like the Frax Space Pool, is that like how like you were thinking when you were like just like this whole evolution, like because Frax was like the first one to be on like Curve Wars, first one to be on Convex Wars. So like, what was your thinking there? Is that like a right sentiment that I was just saying?
Yeah, I mean, well, the work is never done, so I don't think we'll ever, win, quote quote, this chess game. It's always the next move. But like Robert was saying best, it's the money multiplier effect, whether it's in debt denomination or being a liquidity locus against other stable coins, against other tokens. Liquidity begets liquidity, and more debt denomination gets your stablecoin being the unit of account. So we're trying to do these things methodically with a long-term perspective. So the Frax base pool is a way for other stablecoin projects to essentially have their liquidity against Frax and USDC. It's just a dual pool of Frax and USDC, and it provides deep liquidity there, and they can pair all their curve deep liquidity against the Frax base pool. That is really important to get kind of the Schelling point of Frax being really, really liquid against everything else, right? And from there, you can continue to increase debt denomination. And it's all about the three kind of uses of money, right? Store of value, unit of account, and medium of exchange. And so you have to make sure that you're slowly becoming the Schelling point of each of those things, right? And so dollar stable coins, they already kind of have the the medium of exchange and unit of account, and you kind of are also getting the benefit of kind of being the store of value in terms of stable unit, but you have to be able to do that all on chain as well. So that's kind of where our strategy is taking us.
Yeah, with the Frax Space Pool, I listened to your market capping interview like a few times just to like trying to understand and absorb it in my head. And so like before with the three pool, it would just be Frax and three pool, and then other stable coins like MIM and three pool, and whoever else in three pool, and it was very zero sum. Everybody was pitching vote incentives to try to get the emissions. But with Frax Space Pool, there's no Frax and three pool. It's just two pool, and it can just be two pool and whatever stablecoin wants to pair with it. And the emissions that Frax would have gotten in that zero sum game, you're just passing on to the protocol because you're already like your mission's already accomplished there. It's like like you said, expanding the denomination of Frax. Did I explain that right? I'm just making sure that I understand that.
Yeah, no, that's exactly right. And if we can execute it, I think it'll be massive.
Yeah. I see it not just with like other stable coins, right? You could pair it with other unstable assets as well. There's kind of no reason to only hold yourself to stable coins, right, Sam?
Right, and that's where FraxSwap and Curve volatile pools and all this stuff comes in, because as money, the most important thing is you have liquidity against every useful asset. So when people hold Frax, they can easily exchange it at depth to ETH, to BTC, to all this other stuff, right? And so the more liquidity, right, as Robert was saying, the more money multiplier effect you can have through the entire economy. Yeah, I actually have a question for Robert in terms of what's new in what you guys are doing. What's next in terms of any stablecoin research or like historical papers coming or views? Because I think hopefully this podcast will get a lot of listeners to have renewed interest on your previous work and also the OG Signer Chairs paper.
Yeah, no, I mean, we, as I say, we as Clearmatics, the company, are a launch partner to a very exciting kind of layer one project, which is still in stealth mode, but will come out of stealth soon and next, well, this summer. So I can talk more about it then. On the stablecoin research, yeah, I mean, we've done a lot of internal research, and we're going to kind of coincide it with the project that's coming out of stealth. We're going to be like publishing and like kind of heavily kind of engaging with the stablecoin research space again, which is something I regret like not having done over the last few years, and it wasn't out of really choice. It's just bandwidth constraints, you know. So I'm really looking forward to to be deep in the research space again. So yeah.
Yeah, please let us know if Frax can be helpful in any way in terms of either doing on-chain research, developing any AMOs and market operations smart contracts, or just any mechanism design. We'd love to help.
Yeah, no, thanks, and we'll definitely be in touch on that.
Yeah, so Robert, with CBDCs coming out, I mean, you've moderated panels out for the Bank of International Settlements. You're very much more in touch with that world, the world off chain. So like, what is like their reaction to like all these experiments going on and like on like DeFi land? And do you see a world where like CBDCs are integrated into Curve and FraxSwap and like the wider like DeFi ecosystem?
Yeah, I mean, on the second part of the question, I don't know. I think it's I think there's a lot of I think there's a lot of extrapolation that's being done about the CBDC space, and it's actually very heterogeneous. Like it means something different depending on the central bank and the project. And there's most of the stuff is still in research phase, and I personally think it's kind of overhyped in terms of where this stuff is going to go. And a lot of it's going to follow what the Fed eventually does, and I'm pretty skeptical that the Fed is going to create a Fed dollar. But I could be wrong. You know, it's just speculation. In terms of the research side in central banking, I think the central banks have done a really good job in building the research teams, engaging with the community, and doing some pretty high quality research in the space, and it's getting better as time progresses. So I think if in terms of engaging seriously on topics like what we're talking about here today, with the traditional world, I think central banks are probably one of the best places to engage, much more so than the private banking, commercial banking community. And very different audience, and from tech and West Coast tech, which is always looks at the financial stuff in a weird and different way. So, but yeah, I think I'm really encouraged by the the quality of research and thinking that's happening in the central bank.
So do you think these central banks are going to essentially run their own, chain, or have some kind of federated chain in order to issue their token, or would they use something like a public blockchain to do so?
It depends on the project, really, and there are a lot of uncertainties around it. I mean, I think that the default model of like most projects is some kind of private architecture, and not all CBDCs are even around decentralized architecture, so kind of ponder that. Or some kind of federated, permissioned, governed chain. But the prospect of a central bank liability being on a public chain is not like this. Certainly, like things people have talked about, and it's not out of the realm of possibility. I think one of the things that like in the blockchain community we should be thinking about is like an interesting thought experiment is like, well, what if they do that? Like, what are the implications? Like, what are the implications of a Fed coin, or an ECB, euro coin, on say the Ethereum mainnet? Is that a good thing? I mean, what do you guys think? I can tell you my opinion, but I'm curious, more curious to hear yours.
I think it's more stablecoin bull meme accounts. First, but yeah, but actually, I don't think like we have thought about it that much in the community. I know there's been, I haven't heard anything. We kind of view it as, a pipe dream in a sense. So right now, it's like hard to imagine like if like the Federal Reserve issued dollars straight on the chain like that. That's pretty crazy, and what will lead to that? Like, it's hard to say what the ramifications of that would be. Sam, like, what do you think the ramifications of that would be?
Well, I personally am not extremely bullish on CBDCs coming out in scale anytime soon, just because we all know how governments work, right? It's like I think the Fed wire system was supposed to be updated to like a new settlement rail technology like years ago, and now it's like just settling dollar wires on the Fed master account level is like slated to be released, quote, quote, 2026. It's like, okay, 2026. I don't even know what crypto will look like by then, right? And so I think what's really probably going to emerge is this kind of quasi private market innovation, with good regulatory framework, which seems like USDC is kind of in the lead there in terms of closest thing to a dollar CBDC. But then people ask, okay, so what is DAI or Frax's unique value proposition in that sense? And it's like, well, it's a separation of strengths and concerns, right? We have extremely good bleeding edge tech, smart contract development. Like I said, the DeFi Trinity stack that we're building, Circle's never gonna be able to do that, right? And so like they're working in another stack, right? The quasi Fed regulatory traditional stack to make sure that their offering is compliant and as essentially as close to tokenized treasuries or dollars on chain as possible. And Frax and Maker, for example, are the tech stack to expand that supply. That's how I think about it. In fact, Frax and Maker, for example, are doing extremely innovative work on blockchains, on smart contracts, on mechanism design, on expanding the money supply, essentially on the DeFi level, right? And so, in a certain sense, it's just as important as what USDC is doing. If USDC becomes like a quasi CBDC like thing in the next couple of years, I think Frax and DAI will become basically like the JP Morgans or like the Wells Fargo or Citibanks of like the on-chain world, so to speak.
Yeah, I agree with Sam on that. I mean, I think the custodial stablecoins and the non-custodial ones, I think they're really different requirements, and and I think as time passes, those like requirements are going to start to bite, and very different kind of ecosystems are going to develop around like around the two classes of coins. They won't be as similar and composable as they are today. And that's how I see it. I think like the USDCs of the world will be like the coin for on-chain regulated DeFi, and the decentralized ones will be for the kind of permissionless unregulated, and they'll do different things and have different characteristics.
Yeah. You go ahead, Kit, if you had a
No,
question.
I was just thinking about, we talked a lot about USDC and Tether, but we kind of ignore the third largest elephant in the room, which is, BUSD. And Binance have, obviously, their own chain as well. So if we kind of use Binance as a quasi central bank, if they were to come in, that is probably what it would look like. They would have their own chain. It may bridge over to ETH or anywhere else, and they'll have their own native stable coin on there, and that's just how it's going to be ran. And it's worth $1 because they say it's worth $1. No ifs, ands, or buts. And I think that's probably going to be the most likely situation happening.
That's a good point, the Binance economy is huge right now. BUSD is kind of rebranded, wrapped Paxos, right? I think their custody and their off-chain tech is Paxos. But like you're saying, in fact, I like to sometimes compare the Frax kind of economy that we're building more like a, a decentralized version of Binance, right? If you look at the Binance economy, just like you said, they're a centralized exchange, right? So they have liquidity and order books, right? There's liquidity and there's lending, right? They have leverage now and all this stuff, right? There's credit creation. They have BSC, which the Binance company itself doesn't, really do much of, but assuming, they start doing things on chain, like you're saying, what does it look like? It kind of looks like the Trinity stack, right? It looks like they have a currency issuance, they have liquidity, right? Like order book, liquidity and exchange, and then they have leverage, credit creation, lending, debt denomination. And I sometimes talk to all the Frax core devs and all of our team and say, we're kind of building Binance, except we do not have any custody of any funds. All of the products are decentralized smart contracts. We do not run an exchange. We run a AMM protocol, right? We do not do centralized intervention or like leverage, or we don't call up account holders to margin call them or something like that. We don't know anything about our users other than their Ethereum address, right? And so there's a lot of similarities here. The similarities are that it's an economy, right? And its value is proportional to the value and the economic activity that's being generated, and how much of the stack you basically control, right? And we're eventually, this is very, very far out, so I don't like to over promise. Usually I do the opposite of under promise and hopefully over deliver. But we are looking at a Frax rollup, or commonly called like a Frax chain down the line, where if we can combine the whole Trinity stack, right, the final point is to capture the value from the shared state of all of the economic activity and transactions that are going on, right? And so you'd have like a Frax rollup where, having the FXS governance token, you can run either a sequencer or take part in consensus and capture some of the fees there that the economic transactions are generating. And so that'll bring everything closed loop and full picture.
I am so glad you said that, because that is my bull case for Frax, and hearing it directly from the horse's mouth just sounded like such sweet gold.
I usually don't like to hype things or do like too much stuff, because it usually the most important thing is for us to execute on the vision, right? And if you try to hype it up and kind of get credit for it or something before you actually are able to do it, it kind of defeats the point and kind of defeats the fun. But we're totally seeing the entire the journey and kind of like where it's supposed to come full circle. And in fact, if you think about it, I usually say this. I usually say Terra got it the reverse direction. If you look at what Terra did, they first had their L1, right? And then they first had their Terra chain. And they basically were like, okay, this is where all of the Terra economy is going to go. And then they realized, okay, wait a minute, if our product is UST, we're going to have to get our money supply out to every other place that there's large economic activity, right? And in fact, they basically started going cross-chain really quickly, right? Because the Terra chain was fairly small in terms of substantive economic activity, and they didn't want to miss out on stuff, right? If you want your money to be worth something, it has to be used in as much of economic activity as possible. So then they went out and they kind of were like, we got to get everywhere. We got to get on Ethereum. We got to get on L2s and stuff. We're doing it the reverse way. We're saying we have to be everywhere. Forget about having Frax chain or a Frax rollup or anything. There's no value in block space or the shared state ledger if there's very little shared state to actually capture value from, right? So first, let's build the entire thing, and then once block space is valuable, we can think of a Frax rollup or Frax chain.
Amen to that. Yeah, I'm excited for the future to come, and I think like this is a great place to almost end it. I just have like one more question, like the current state of like the market now, and just like the macro in general is like pretty unprecedented, and something that hasn't been seen in a long time. And I'm just curious, like what your guys' thoughts on like the current, the current macro situation, how crypto relates to the current macro situation. Because like my kind of view on it is like Bitcoin it's like pretty correlated with the traditional like institutional system already, but like DeFi and there are certain like things in DeFi aren't as much because it's just like so new and institutions don't have the same exposure to it. So what's your guys' current view on the macro and like how like DeFi and stablecoins like relate to that, and like do you think it'll affect like its performance at all? I don't think it like has anything to do with the potential. I think we all agree like we're all like stable, huge stable bulls here. But like what do you guys, like both Sam and Robert, like what do you guys think of that?
I'll let Robert take the full floor on this because he's the expert on high level stuff. So I'm really interested to hear this.
Yeah, no expert on anything. Certainly not seeing the future, but yeah, I mean the macro environment is awful. And like even if you take the kind of base case that like the consensus, with the twos tens yield curve that flat, it's kind of telling you that interest rates Fed's going to hike to like 3 to 3.5%, by the end of the year or the next year, and we'll get a recession, and then inflation will come under control. The combination of like where we are today and that scenario is like really bad for risky assets. And I think if that scenario turns out to be wrong, and the inflation that we're seeing is going to get worse and gets baked into people's expectations, and it's like the 1970s all over again, then that's going to be a really kind of tough place for everything, but including crypto, because like one of the undertold like stories, I think, since the last 10 years in crypto has been like the role of like super low, unnormally unhealthily low interest rates and expansionary monetary policy and growth in central bank balance sheets since the great financial crisis. Like that's played a big story in crypto valuations, and it's played a big story in like the design of these protocols, which basically like most of them kind of assume like a background like dollarization and the interest rates like always low and stable. And like when that changes, like it's going to change like kind of a lot of the assumptions that people make around how to design these protocols. And like I think what we'll see is valuations in like protocol valuations, whether layer one or layer two projects, will get more real. Like they'll be more focused on like what's the actual volume of activity and like value creation, value capture that's happening in these protocols. So I think the valuations will get more realistic. And I think there'll be more focus like on the use case side. I think we more focus on like use cases that are like solving real problems and allowing you to trade like real risks outside of crypto assets. Like a lot of the kind of raw speculation will it'll always be there, but it'll be different. It won't be the it won't be the raison d'etre of like activity in the space, which is largely the case. And I think it's all that's all really positive stuff. The silver lining in it all is that the value creation that comes from real use cases in DeFi will make it last. So that's my summary for what that's worth.
Yeah, really well said. Basically, those orthodox views will probably come into analyzing crypto valuations more, right? Like real world things, cash flows, things like that, which is how we started this
Yeah,
conversation. So totally agree.
I think they will, and I think we should welcome it, like reality. So like let's do it. There's nothing wrong with it.
Coming back down to earth.
Yeah.
Well, yep. Wow. Well, this has been an incredible hour and a half. I learned a lot, lots of really insightful conversation here. And I think this is something like a lot of people will get a lot out of, and like something like we can go back to in the years to come. So like, honestly, thank you guys. This has been real special. Sam, Robert, thanks for coming on. Kit, always being a great co-host. And yeah, we'll see you guys in the next one.
Thanks. Really enjoyed
My
it,
pleasure.
guys.
Thanks, guys.
Thanks,
Bye.
guys. Bye.
Wow, what an episode! I mean, I'm just speechless right now, dude. Like,
I know.
wow, mind blown. What do you think, man?
My head kind of hurts, but in the best way possible. It's just like when you like lift weights, like you literally like break down the muscle, and that's how like new muscle forms. It's like I feel like I like intellectually lifted weights in this conversation I had with both Sam and Robert here, and I think like everyone who like made it all the way through the podcast and listens to this a few times is going to have that like same like breaking down and like building up of intellectual muscle tissue. So definitely something real special.
Yeah, dude, and the sheer amount of alpha, I was just
Oh
getting
my
like
God.
punched in the face with it, like left and right.
I know you're
But
going to have to get some ice for all that alpha.
I know I need the ice for the alpha punches, and also some ice for my sore brain right now too. So well, either way, this was the Flywheel Pod. I hope you guys enjoyed it. Make sure you follow us on Twitter and Telegram at Flywheel Pod, and make sure you follow and subscribe to us on YouTube as well. I am your co-host, Capital K. You can find me on Twitter at 0x_K. And then my co-host, Dave.
And I am DeFi Dave. You can find me on Twitter at DaveSaidThat_. And we'll see you next time.
Peace.